A very good afternoon, ladies and gentlemen, and welcome to IIFL Wealth and Asset Management's Q2 FY23 earnings call. As a reminder, all participant lines will be in listen-only mode. There will be an opportunity for you to ask questions after the management shares their initial thoughts. Should you require assistance during the conference, please signal the host by tapping on the raised hand icon. Please note that this conference is being recorded. On the call today, we have with us Mr. Karan Bhagat, Managing Director and CEO, Mr. Yatin Shah, Co-founder of IIFL Wealth and Asset Management and Joint CEO, Wealth, Mr. Anirudh Taparia, Co-founder and Joint CEO, Wealth, Mr. Anshuman Maheshwari, Chief Operating Officer, and Mr. Sanjay Wadhwa, Chief Financial Officer. To walk us through the numbers, I invite Sanjay to please take this forward.
Thank you, Anil, and a very good afternoon to everyone on the call today. The financial markets during the quarter ended in the positive territory. However, came in with elevated volatility as domestic flows competed and countered net outflows from FII. The macro factors remained relatively resilient amidst weakening global environment, with performance parameters indicating recovery in domestic activity and INR holding up relatively well in the environment of free fall of currencies. With that said, the sentiment continues to remain cautious on the back of headwinds from extended geopolitical tensions and tightening global financial conditions. Amidst all of that, we are happy to give an overview of the current quarter of IIFL Wealth and Asset Management. Diversified portfolio mix, healthy net flows for the quarter, and continued focus on revenue recurring stream have held us in good stead. From that aspect, jumping onto our financials, we have seen growth across all our key metrics in the form of AUMs, net flows, revenue, steady retentions, and profitability. Happy to report we clocked our highest ever PAT in this quarter, which is Q2 FY23. Some specific financial numbers. Starting with assets under management, our total AUM is now more than 333,000 crore, up 5.8% year-on-year and up 6% quarter-on-quarter. Excluding custody, our overall AUMs increased 5% YOY and 6% quarter-on-quarter to 268,000 crores, with wealth management AUM at 212,000 crores and asset management AUM at 56,000 crores. Importantly, our ARR assets increased 8% QOQ and 17% YOY to 155,000 crores. With this, the share of our ARR assets in total AUM now stands at 58% as we continue our journey towards steadily increasing the pie of ARR assets. Happy to share that despite the market volatility, our net flows have been relatively strong for the quarter at 6104 crores. Our loan book for the quarter was at 4284 crores, marginally up by 3%. Revenues and retentions. Our total revenue increased 12% YOY and 10% QOQ at 405 crores. As compared to Q2 FY22, our revenue from operations was up 22% YOY and 2% QOQ at 382 crores. Importantly, our recurring revenues have increased 5% QOQ and 17% YOY at 261 crores. As a percentage of operating revenue, recurring revenues now comprise 68%. This quarter has seen stable transaction revenues at 122 crores. Our retentions across wealth and asset management segment hold steady, with wealth management retentions at 54 basis points and asset management retentions at 79 basis points. At an aggregate level, our overall retentions are at 59 basis points. Moving on to expenses for the quarter, our cost to income ratio has improved to 44% from 45% in Q1 FY23 as we continue our focus on costs. Our total expenses for the quarter is up 7% QOQ and 3% YOY at 179 crores. Administrative and other expenses is up 12% QOQ at 48 crores. Coming to profitability, as stated earlier, we recorded our highest PAT at 173 crores, an increase of 23% YOY and up 8% QOQ. Importantly, our tangible return on equity, which is ROE excluding goodwill and intangibles, has further improved to 28% for the quarter from 24% levels in September 2021. With that, we come to the end of our financial highlights, and I'll now hand it over to Anshuman to cover some key business and strategic highlights.
Thanks, Sanjay. Good afternoon, everyone. The last few months have continued to be dominated by geopolitical and global macroeconomic events. Amidst this, the three core tenets of our strategy that we've continuously shared with all of you, growth, resilience, and agility, stands firm, and we continue to measure our decisions as well as performance against these three strategic principles. At the outset, as Sanjay shared, our overall financial performance, the final output metrics remain strong, specifically highlighted by the continued ARR AUM and ARR revenue growth of 17% and 23% respectively for the first half of FY23. And the strong profit after tax, which stands at 333 crores for H1, a growth of 28% over last year. Some key positives underlying the final financial performance gives us confidence to be able to sustain the positive momentum. Some of these are specifically around net flows. So not only have net flows been at over 6,000 crores and remain strong in the current environment, specifically retentions have remained firm at 71 bips on ARR and over 60 bips on an aggregate basis. We have seen our highest ever quarterly net flows in IIFL 1 at about 3,450 crores. To put this in perspective, our full year net flows for last year under IIFL 1 was about 3,500 crores. And this is a reflection of the robust build-up of our advisory proposition and strong client traction for the same. While overall net flows for the asset management business is low at 53 crores for this quarter, I wanted to highlight two specific aspects underlying this net flow. We had planned distribution from some of our older AIFs of about 465 crores in this quarter, and liquid mutual fund, which we know will remain volatile, saw net outflows of over 300 crores. Adjusting for these two, flows remain healthy, driven by the strong traction specifically on our credit strategy, which saw net flows of over 750 crores. We understand market cycles, and as we build our alternate asset management business, our diversified strategy across listed, unlisted, credit, real estate, and infra allow us to go through these cycles with a stronger and with higher resilience. We continue to invest significantly on talent acquisition and technology. We are seeing senior people join us across wealth sales, investments, as well as the operating functions, specifically technology and digital. However, we are doing this with a judicious view on sustaining our cost to income to around the current level of 44 to 45%. As you would recall, we have had a strong focus on capital efficiency over the last couple of years. Accordingly, we are happy to report that our tangible ROE is at 28% and absolute ROE is at 23%, vis-a-vis 12.5% at the end of FY21 and 20% at the end of FY22. We expect to sustain this at the 23 to 25% levels. In line with the above, we are pleased to announce the third interim dividend of rupees 17. This aligns with our dividend policy of 70 to 80% PAT payout to our shareholders and also continues to position us fairly uniquely as a high growth and high dividend yielding company. Quickly on a couple of other business updates, just an update on Mumbai Angels. We await SEBI approval, given that Mumbai Angels has a Cat 1 AIF license, and we would expect to complete the transaction in the current quarter. We are developing strategic plans for taking this remarkable platform forward, and will share further details post the completion of the transaction. Secondly, on the mid-market segment, our work on developing a strong digital-led proposition for the next segment of wealth clients continues, and we are on track to showcase further by the end of the financial year. With that, I'd like to hand it over to Karan and open the session for Q&A.
Thank you, Anshuman. I request all of you, please click on the raise hand icon in case you wish to ask any question. We'll give it a minute for the questions to queue up. First in line, we have Mohit Mangal. Kindly unmute yourself and ask your question. Also request you to please introduce your firm before you ask your question. Thank you.
Yeah, hi, good afternoon, everyone. This is Mohit from Bob Capital. So congratulations on reaching the 170 crore net profit mark. I have specifically three questions. First is in terms of the net flows. I believe that even if I take that two outflows that were planned, I believe that it would be lower than your expectations. So can you elaborate on plans, so that we have a higher net flows for the H2 financial year 23?
Yes, Mohit. I think that's a fair statement. I think the net flows are slightly lower than what we would have ideally liked. I think on a gross basis for the year, I'm kind of adding H1 and H2 together. We would ideally like net flows of somewhere between the 35 to 40,000 crores for the year. But most importantly, I think more than the 35, 40,000 crores number, we are striving to ensure that the ARR net flows, which is the AUM giving us a recurring revenue, should be closer to the 30-odd thousand crore mark. Relative to the 30,000 crores in H1, we are close to around about 10,500 crores. So around about 3,000-4,000 crores short of the net flow number. But just given the focus we have, I feel we will be fairly close to that 30,000 crores for the full year. Maybe 1,000-2,000 crores short, but not dramatically lower than that.
Perfect. I mean, in terms of the net flows, I mean, just to follow up on that, what are the flows coming from the existing versus new clients?
I think it's a combination. Honestly, I think continues always like it is in every financial year. I think our market share with most of our older clients is fairly high. It's in the region of somewhere between the 40 to 70%. In terms of new clients is where the lumpy flows kind of come in. So typically you see on a quarterly basis, the split would be closer to the 2/3, 1/3. So 65 to 70% would be coming from new clients. 30-35% would be coming from the older clients.
Perfect. My second question is on the carry income. So we saw 35 crores, of carry income in the first half, and I think in the earlier calls you have guided for around 75 crores. So I mean something, you stay with your numbers or revise it?
Yes, I think carry of roundabout the 70-75 crore number is a fairly predictable and more or less a given number over the current year and the next couple of years. Outside of this 75 crores of carry income every year, there will be potentially some more lumpy carry income which can come in the next year and the year after that. But on the 75 crore number, there's a fairly high probability and degree of certainty of accrual over the next 6 months and also over the next 2 financial years.
Okay. My last question is, broadly industry based. So I was reading somewhere that, a lot of HNIs and UHNIs have shifted their geographical base outside India post-COVID. I mean, how is our business affected by this, and what are the what are the return expectations of these clients?
So I think I'll answer your question in 3 parts, Mohit. I think the quantum of such people over a base of our entire client population is still in single-digit percentages. So it's not a disproportionately high number. It would still be in the region of 2, 3, 4, 5, 6%. Most of these clients have not themselves fully shifted out. In some senses, they have what I would like to call their left leg outside the country, right? So in some cases, it's the spouse, or in some cases, it's a brother who may have become an NRI. In those cases of 7-8% of our clients. Within that, you essentially have 2 kind of flows which go out. One, you have the capital flow, and the other is the current income flow. So capital flow is also subject to a cap, even once you become an NRI of close to $1 million per financial year. So even though you end up becoming a NRI, the quantum of money moving out is going to be taking us a fairly long period of time. Where what goes out obviously is the current income. So effectively any dividends, rent or interest post you becoming NRI effectively kind of starts moving out. So if you kind of combine both, which is the 7-8% of the broader client set, and the fact that it is going to be more current income as opposed to capital, the quantum of money moving out of the existing base is fairly low. But return expectations, to answer your question third, on today's age would be closer to the 8 to 9% in dollar terms as compared to the 9 to 10% in rupee terms, especially because the global bonds have kind of corrected substantially more than the Indian bonds. And effectively today you've got investment grade to close to slightly below investment grade, which includes a lot of India bonds, quoting close to the 8.5, 9%. So I think from an expectation perspective, clients are in that ballpark number of 8 to 9%, but in dollar terms as compared to rupee terms.
Right. That's very helpful and wish you all the best.
Thank you, Mohit.
Request you to please click on the raise hand icon to ask your question. Next in line, we have Prayesh Jain. Kindly unmute yourself and ask your question.
Yeah, hi everyone. This is Prayesh Jain from Motilal Oswal Institutional Equities. Karan, firstly on if you look at the Anshuman mentioned about the advisory business in IIFL1. Could you elaborate more as to what it is and how do you think that this would scale up? Because that is kind of dilutive to your overall IIFL1 yields, and I think we had guided for a 40 bips kind of yield for IIFL1 over a medium term. So both of them don't kind of corroborate with each other. So what's the thought out there, and could you give us more details as to what is this advisory in?
So I think there's some lots of terms there which are being used in some senses fungibly. So maybe I can kind of help clarify. So there are two kinds of segments there and three levels of service, right? So effectively in terms of levels of service, there is really the discretionary and the non-discretionary stroke advisory level of service, right? So typically we've seen retentions on the discretionary side being closer to the 60-65 basis points. On the non-discretionary advisory side being closer to the 35 basis points. And on a blended basis, that's really ending up at closer to the 40 basis points. Where the equation really breaks is if you are doing advisory for corporate treasuries. That really happens more for a nominal fixed fee as opposed to having a retention of 35 to 60 basis points. So the 40 basis points guidance for us is excluding the corporate treasuries. Outside of that, we really don't see any change to the hypothesis. On the non-discretionary advisory side, we continue to see around about a 35 basis points retention. On the discretionary side, we continue to see a 60 basis points retention. So stripped for the corporate advisory portion, I think the retention will continue to be in the region of 40-45. So maybe just we'll take an input from your question and also start within IIFL1 reporting corporate treasury separately so that you get a better idea of the ongoing yield.
Yeah, that will be helpful. That will be. Yeah. And secondly, Karan, just extending the previous participant's question on the net flows. What gives you confidence of getting to that 30,000 crore kind of a mark, given that the kind of environment we are in, whether look at the global scenario or even in India, we're talking about high interest rate environment. So what gives you confidence of reaching that 30,000 crore for the full year?
So there are two elements to that net flow, right? So on the ARR element of reaching the 20,000 crores incremental, we've got around about 30 to 35% of that net flow, essentially coming from AUM, which was it's basically a line which we report separately, saying essentially AUM sold earlier, where upfront was received earlier, but it's essentially maturing over the next 18 odd months. We've seen a very high ability to convert a large part of that AUM into the ARR AUM bucket. And we believe that over the next 6 to 18 months, if I just break it up in the 6 months and the 12 months bucket, we have at least 30 to 40% of that AUM maturing. And we are fairly confident nearly 2/3 of that AUM, we would be able to move into the ARR bucket. So if I would just see out of the incremental 20,000 crores, I think 4,500, 5,000 crores over the next, or maybe 6,000 crores across the next 6 months would be a kind of a function of our ability to convert some existing non-revenue bearing AUM to revenue bearing. The remaining 13,000-14,000 crores is essentially we'll have to get out and get the net flows. There, I think it's going to be a little bit of combination, as I said earlier, between 2/3 coming from net new clients and a third essentially adding wallet share from our existing clients. I think to a certain extent, obviously that is subject to a little bit of market volatility. But typically what happens is a lot of these transactions have already got consummated or are in the process of getting consummated. So I think our ability to add close to around about 5,500 to 6,000 crores a quarter net new flows with a little bit of volatility in the market should be there. So I think if I look at the 20,000 crores of incremental ARR assets, I think I would break it up into saying 5,000 to 6,000 crores is going to come from older assets which are going to move from assets which are non-revenue bearing to revenue bearing. And I think we should be able to reach the current quarter numbers of 5,000 to 6,000 crores of net new flows, coming 2/3 from new clients and 1/3 from existing clients.
Thanks. Just last question, and this is more on a RM count basis. Have you seen any increased attrition in with regards to now that we are on a complete new model in terms of payouts? So have you seen any increased attrition, or what would have been the attrition in the first half? And any thoughts going ahead as to how do you see the entire industry panning out, given that there is a lot of money which has been invested in your competitors, where they would go in for an aggressive, possibly RM acquisition. So any thoughts around that would be helpful. Yeah.
Actually, attrition for us on the relationship side has been fairly low single digits, and that's continued. And as we go up the tree in terms of seniority, it falls even further. We did see a little bit of attrition in the firm, but that was largely on the corporate side of corporate functions. We've not really ended up seeing too much attrition either on the sales relationship side or on the investment side. Having said that, I think most of our larger competitors now appreciate the importance of advisory as we go along. And I think where maybe 3 years back there were only 2 firms largely talking about advisory and non-discretionary. Today, I think that number has definitely increased to 6 to 7 firms. So I think from a relationship manager perspective, finally it's going to be about working for a platform where they can get the highest wallet share from the client, as opposed to necessarily a platform which is able to get him a slightly quicker distribution revenue. So I honestly feel a change of the business model, given the fact that we finished the 2.5 years. Most of our relationship managers today have close to around about, with varying degrees, close to around about 35-40% to 60-65% of their revenues coming from ARR assets. They are actually feeling substantially more comfortable in the existing platform as opposed to going out and building all of that afresh.
Great. Thank you, and wish you all a very happy Diwali and happy New Year.
Same to you. Thank you.
Thank you. Next in line, we have Kunal Shah. Kindly unmute yourself and introduce your phone.
Hello.
Hi, Kunal.
Yeah. Hi, Karan. How are you?
All well, all well.
Yeah. Firstly, again, with respect to the inflows into IIFL 1, and you spent some time in terms of discussing about the non-discretionary advisory. But would it be fair to assume that maybe the traction in the discretionary will continue to be relatively on the lower side, and as the overall proportion of the pie, maybe the AUM in discretionary PMS would be coming off within the overall IIFL 1 assets?
I wouldn't think so. So I think once you remove the corporate advisory, I think the split would remain 1/3, 2/3, with 1/3 coming from discretionary and 2/3 coming from non-discretionary. I think there's a very good acceptance of our discretionary platform, what we call internally is IIFL 1 mandate. And I think in all our new client wins, we are able to see at least 10, 15, 20% of the portfolio getting on the discretionary side. So if you ask me today, I think the percentages will remain. I think it'll be broadly 1/3 discretionary and 2/3 advisory or non-discretionary. But over a longer period of time, what we've seen, at least in the developed markets, including US and Europe, the proportion kind of moves away from 35-65 to closer to 50-50. So actually discretionary moves up over a period of time, but I think we are some time away from that. I think we will end up being closer to the 30-70, 35-65 kind of proportion.
Sure. And secondly, with respect to the overall cost to income, so again, this quarter there was some element of, say, other income compared to that of the last time, which also provided the benefit. But would that also translate into any kind of a variable component? And if we have to adjust for that, then maybe still on a stable state basis, we expect cost to income to still be sustainable, maybe if there is no further support coming in from the other income going forward.
So I think from an other income perspective, Kunal, the way to look at it is broadly outside the NBFC, our investments are in the region of 700 to 800 crores. Obviously, then adjust a bit for working capital and so on and so forth. So effectively, at any point of time, we would have broadly 550, 600 crores invested either in a range of things, right from fixed deposits to bonds to some of our own alternative investment funds. So I think that on a yearly basis would be largely 75, 80 or maybe 70, 75% into fixed income kind of instruments and 25, 30% into equity related instruments. So I think on a broad year basis, I think the other income number will aggregate somewhere between the 60, 65 crores on the lower side and 85, 90 or maybe a max of 100 crores on the upside. So I think obviously on a quarter to quarter basis, it will fluctuate a bit, but I think the overall annual number will be between the 60 to 100 crores. And I really don't see any large movements in cost to income either. May happen, if it's a very sharp movement in one quarter. But on an annual basis, 60 to 100 crores is broadly what I would see as the number which we'll see on the other income side. In terms of the modeling itself, we are obviously slightly on the conservative side. We look at the other income in the region of 60 to 70 crores in terms of a broader thought process.
Sure. And as we are already done with H1 and 6 months and looking at the overall capital market environment, are we willing to tweak any change in the guidance which we have highlighted post March 22, be it either in terms of flows or maybe the AUM growth or on any other aspect? Yeah.
Yeah. So I think from a guidance perspective, ideally we kind of trying to tweak it or revisit it typically at the end of the third quarter with relative focus on the next year. But in terms of the current year itself, I think there is, if I was to look at the net flows, I think we would be very, very keen to meet the entire ARR net flows guidance, which is closer to the 28,000-30,000 crores. The overall net flow AUM, which really doesn't have an impact on the business itself, may not be closer to the 35,000-40,000 crores, maybe closer to the 30,000-35,000 crores. That's the only thing I would say. But outside of that, don't really see any big reason to revisit any of the other numbers over the next 2 odd quarters.
Okay. Yeah. Thanks and all the best. Yeah.
Thank you.
Thank you. Next in line, we have Avinash Singh. Kindly unmute yourself and ask your question.
Yeah, hi. Am I audible?
Yeah, Avinash, you're audible.
Yeah. Hi, Karan. So 2 questions. The first one is not so much at the moment, in this capital focus area, the mutual fund business. In the scheme of things, it is still kind of, a bit subscale. And the fact of matter is that, building an active MF business in the Indian market context is a long journey and a challenging task. But, gradually, probably, the passive is where the focus is coming also in India. So does this passive-led growth fits into your strategy, or is it like, what are your thought process in this, I would say a few multi-year journey when it comes to your mutual fund business? That's the first question. After that, we come to the second.
So Avinash, honestly, I think as we speak right now, I think the mutual fund industry itself, in some senses, can get largely divided, as you rightly said, between actives and passives. I think as we've kind of pointed out earlier, at the immediate short term, we really don't see a right to win on the active mutual fund space, and effectively there will be a little bit of friction in us going out and building the last mile on the mutual fund side, and that's really till we don't establish a clear right to win. We've not really kind of gone out and invested in that business substantially. On the passive side, you're right. I think as a segment, it's going to be fairly large. And obviously it comes with two challenges. The first challenge obviously is how do you build out the cost economics for a passive business? So obviously, if you end up building a good passive plus business, which I would broadly say are things like index strategies with a little bit of modification and a little bit of alpha. There obviously you can end up with 15, 20, 25 basis points in terms of retention. But you'll have to build the cost economics very carefully on the passive business between just doing pure simple plain vanilla index funds versus index plus kind of strategies. And secondly, I think we'll have to consider culture also, because while you build out passives and you build out a very strong alternate investment book, the kind of fund management expertise and the kind of sales teams you're building internally are fairly varied and different for both the businesses. So honestly, if you ask me, and I'm kind of break it up into three parts. One, I'm just going to talk about the business which we are focused on, which I loosely call as the alternates and the public market business. The second is really the actives business, which is mutual fund, and third is the passives. Honestly, I think for the next 12 to 18 to 24 months, we see a huge amount of potential on the alternates and the public market business. And that's really where I think we are going to be spending a large part of our time and energy, both in terms of new product ideas as well as new asset classes. That's really where a large part of our focus is.
Thank you. That's clear. A second part is second question is more industry than the player. I mean, there is a huge amount of operating leverage in your wealth management business, and of course that comes with a scale. So basically, the top 3-4 players will be a different profitability zone vis-a-vis a newcomer, and of course it takes a lot of time. Now, where industry stands today, of course we have sort of a movement at each end. So going forward over the next 12 to 24 months, do you see a scope for further consolidation with some of the top players kind of acquiring the bottom ones, or you see more entrants coming into this? How do you see this industry dynamics, if I have to look?
So I think to answer your question, on the asset management side, on the alternate side, obviously there's fair amount of operating leverage. We spent a lot of time over the last 2.5, 3, 4 years building investment capabilities in each of our strategies. I think today to scale up all our strategies to maybe 3 to 4 times the size what we have today would not really require us to invest massively on the investment teams. A little bit of additional investment on the distribution and sales side of the business would be needed. But you're absolutely right. I think the operating leverage on the asset management side should show up fairly high, in a fairly meaningful manner over the next 3 to 5 years. On the wealth management side, also you're right. I think there is a lot of operating leverage, especially in light of the fact that today, if you want to go out and be the wealth manager of choice with the client, you need the full investment on the platform. The platform today is fairly large. It needs a lot of expertise in everything, starting from products, building out a family office structure, building out the right governance mechanisms, building out the right, having a small NBFC to support the clients, ensuring that you're able to give them advice on multiple things, right from succession, trust planning, having the right advisory team in place, having the right quasi asset management structure for the discretionary business. So all of these things effectively need to be amortized over the wealth management AUM you are handling. And today we would be among the few players who've got all of these things in place. And in that sense, obviously the operating leverage kind of shows up. Having said that, there will be wealth managers who will be able to service maybe individually 4, 5, 6, 7, 8 families. But those will be relatively fragmented businesses. They really won't be businesses which would achieve scale. I think to achieve scale and finally become large, you would need to make these investments. And therefore, there will be sooner than later discovered minimum AUM you would need to be able to do this business profitably. I think it's too early in the journey of wealth management in India to decide what that AUM is. But as you go forward, both technology and regulatory costs would also come in. And effectively, the technology, regulatory, and the platform costs put together will require a certain amount of minimum AUM to do business profitably. And beyond a certain AUM, obviously the operating leverage will start kicking in very efficiently. But I think we're still in a fairly nascent stage on the business to be able to discover these numbers perfectly. But from an IIFL Wealth perspective, I think we are more towards the north side, where I think we have some bit of capacity on the relationship manager side. We're fully invested and built into the platform. So ideally, we will see some benefits of operating leverage over the next 2-3 years.
Okay. Thank you.
So we'll move on to the next question. Next in line, we have Aejas Lakhani. Kindly unmute yourself and ask your question.
Yeah, hi Karan and team, and congrats on the results. Karan, you've made 2 acquisitions over the last 5 years, and there has been fairly some time since you've made these acquisitions. So could you just walk me through, how these acquisitions have done in terms of how clients have grown, or have the RMs who you acquired stayed on? How's their journey been, and your key learnings from these 2? Thanks.
So I think both the acquisitions have been slightly different experiences, to be honest, Tejas. I think the wealth advisors acquisitions really held up extremely well. I think both in terms of people, in terms of clients, in terms of the people who've they've kind of expanded their own roles and responsibilities. They've been able to add more to the business in terms of their own skill sets. Clients have expanded their wallet share in a substantially larger manner, and obviously, the profit metrics and the AUM numbers have followed. In the case of the second acquisition, I think story is slightly different. I think the profit numbers and the revenue numbers have held up in the second acquisition. Just from a pure financial perspective, the numbers are there. But from a people and a client platform perspective, I think we've not really had the same leverage benefits what we would have assumed which we had in the first transaction. So ideally speaking, I think the second acquisition could have done slightly better compared to the first one. In terms of pure numbers, it's stacking up, but in terms of the scale-up benefits and the synergy benefits we would have liked to see is something which we've not really seen. And consequently, even in terms of attrition of people, the second acquisition has seen a little bit more attrition. The first one's practically seen next to zero attrition altogether. So ideally speaking, I think if you ask me from a pure learnings perspective, I think the first acquisition got integrated into the system extremely well. Second acquisition obviously was through COVID in some ways, so integration could have been potentially better.
Got it. And the attrition that had to take place from these acquisitions is behind you already.
Yeah. Some of them are in this quarter, but yes, most of them are behind us.
Got it. And in the opening comments, Anshuman mentioned that there's been a planned distribution of about 465 crores. Is that the reason for the decrease in AUM on the private equity side and the gradual taper off?
No, so I think if you just look at the broader strategies, we continue to make distributions through the sunset period of the funds. Obviously, we have a large fund which is the Special Opportunities Fund, which was Series 1 to 7, which was raised in 2017-18. It was close to around about 7,000 crores in terms of size, and they mature starting from 18 months back all the way to 18 months forward. So we've already returned capital plus close to maybe 2,500-3,000 crores to clients. And obviously, all the distributions in the last year more than got offset by the new funds which we had raised on the private equity side. In this current quarter, obviously, now we're left with in some senses, the 5,500 crores of those older funds, which are largely representing the gains to get matured over the next 18 to 24 months. And of that 5,500 crores, 450 crores of redemptions came in this quarter. And our credit funds raised down about 800 to 1,000 crores, which got offset by the 465, 500 crores of redemption on the private equity side, and around about 300, 350 crores of redemption on the liquid fund side.
Noted. That makes a lot of sense. And your ability to, get the monies that is exited, reinvested remains very high. Is that understanding correct?
Yeah, so I think you'll have to break it up into three parts. I think one are clients who are associated with us on the wealth management side. I think there essentially I think there is a huge amount of ability for us to be able to retain the asset. We've typically seen it being as high as 60 to 70%. Where essentially there's a third party distributor, it needs a good new product idea. If there is a good new product idea, I think there is a 30 to 50% probability of the AUM coming back. So that's really where it is. In our experience, I think if I just look at the funds over the last 12 to 18 months, we've seen broadly 55 to 60% of the AUM stay with us.
Got it. That makes a lot of sense. And Karan, last time, I think a quarter or two back when we spoke, you were quite enthusiastic about the multi-asset product, but that's been sort of flattish. So any thoughts on that?
So I think the multi-asset category is a new category. I think in terms of volumes, it will take time to build out because we will need around about, it's fairly bespoke in nature. So in some senses, it needs to develop ideas. I think in terms of the AUM impact, you'll see larger flows coming through credit, infra, and so on and so forth spaces, especially the inflation-based assets over the next 6 to 12 months. I think the private equity side in terms of new flows will remain a little tepid. And you'll also see, I think the public market flows kind of pick up over the next 6 to 12 months. The multi-asset bespoke strategies on the asset management side, I think will take some. It will be kind of a derivative of the strategies we build out on the credit and the infra side. But I think the larger growth will come on for the next 12 to 18 months on credit and infra.
So got it. That's very clear. And just on the 5,000 crores of the soft fund that you were mentioning that sort of mature over the next 18 months, given that primary markets are the way they are, do you see any challenges in terms of from an exit perspective there?
So actually, it's a fairly concentrated position of the 5,500 crores. I think if I'm not wrong, 50% of it is, or maybe 60% is a national stock exchange. Yeah. We exited all our listed positions, I think 14, 15 months back and distributed it out. So it's largely national stock exchange. There's a small amount in BKG, Northern Arc, and NSDL government. So I think fairly large, good, solid positions. So I really don't see too much of a challenge here.
Noted. Thanks. All the best.
Thanks. Next in line, we have Sanjay Kumar. Request you to kindly unmute yourself.
Hi, Karan.
Hi.
First is just a clarification. So you were talking about old assets with upfront fees of 11,339, right? And of this, you're expecting to convert 5,000 crores to trail basis. Is that understanding correct?
4,000 to 5,000 crores in the current financial year.
Okay, got it. And
so
in terms of
you'll have round about half of it getting matured this financial year, of which we should be able to convert 70-75%.
Got it. Thanks. So next one, given that 2/3 of net new flows come from new clients, so in terms of sales and leads, what do we have to do differently to push the 6,000 crore run rate that we are seeing currently in the last 3 quarters higher? Or is it because of scale, because at 2 lakh crore AUM, 10% growth from flows is 20,000 crores, but we are hitting 3 lakh crore, 10% on that AUM higher base will be 30,000 crores. So is it because of scale or do we have to do something differently in sales and lead generation?
No, I think we have to do, it's not, I don't think so we are anyway, I don't think so we have that scale or size to honestly feel that 10% of 2 lakh or 10% of 3 lakh will be a challenge. I think we are some way away from that in terms of the size of the market. I think we need to do a little bit more on the sales side. I think both in terms of expanding geographically as well as kind of maybe slightly improve our conversion ratios from 60-70% of new deal wins to maybe 75-80%. is what we need to do. So I think honestly the answer is more on the sales side. It's not really on the size of the market. I think that for that we are still far away in terms of market share to really say that 20,000 versus 30,000 is a function of the size of the market.
Okay. And second on the next big lever, right? The 5 to 25 crore net worth clients. So is the customer acquisition or the sales process be any different from the existing setup? So please share in detail, the strategy on how we are generating leads or how we are converting clients. Where are we on that process?
So honestly, right now we're not focused on the generating lead side at all. There, I think our focus there right now is to build a much more lighter, more efficient digital delivery tool and understand the strategy of the business. I think we've spent a lot of time and energy on that, and we're fairly confident that we have a right to win. In terms of onboarding clients and really reaching out to them and kind of getting them to start looking at doing transactions, it's only by the end of the current financial year where we'll really go live in that sense. So it's only in March, April we really go into the segment where we start onboarding clients and so on and so forth. But as we speak right now on the planning side, it's more a function of looking at what differentiates us. And I think in order of what differentiates us, I think we'll have to take a three-pronged approach, both in terms of the entire product distribution piece, the ability to understand the client and convert a product offering into advice, as well as the ability to be able to reach out to him in a effective manner and work on an effective delivery mechanism. So I think in terms of just the conversion itself, we haven't really started that process. That's still kind of slated for an April launch. But in terms of the thought process, design, the build out, all of that's happening aggressively.
Okay. And any color or some commentary on who are the competitors in this space and what will be our go-to-market strategy, our right to win?
So I think from a competitor's perspective, I think pretty much most of the larger banks today are servicing those segments in the largest manner. So if I was to, pretty much all the retail large banks in India would be servicing those segments. The challenge for us is obviously acquiring those clients, because those clients kind of walk into the bank in some ways, either through a salary account or through a home loan or through a mortgage or through some credit card and so on and so forth. So the ability to acquire those clients is substantially higher. The ability to also make fee income out of things like forex and net interest margin is also substantially higher. So those are our two challenges. The opportunity obviously is the maturity of this client is increasing dramatically. He's wanting more and more to engage with wealth managers, have a structured process around his investments. And third, he wants to look at all the ancillary services, and most importantly, focus on the newer product ideas. So there are certain challenges and there are certain opportunities. It's really going to be a function of how well we can merge these two while managing the cost to income ratios in the right way to be able to drive success out of it.
Thank you, Karan. That's it from us.
Thank you.
Thank you. We have Prayesh Jain with a follow-up question. Kindly unmute yourself, Prayesh.
Yeah, hi. Thank you for the opportunity again. Firstly, just extending the last point, so in the broking industry, we saw that if we are trying to do the same thing in the same entity, we see a lot of challenges. Trying to do a discount broking as well as the traditional broking in the same entity, it becomes a challenge. Like, for example, I'll just give you an example of ISEC. But on the other hand, IIFL has been able to set up the traditional broking as well as the discount broking separately, and done well. Do you see that kind of a challenge, while working in the smaller AUM category in the same entity will lead to some challenges with regards to the brand value that you have created amongst the ultra HNIs?
So just maybe as a clarification, we're really not looking at going into retail in a way, right? So I think we'll still be focused more on the 5 to 20 crore category. So in some senses, I understand your question fully, and I kind of agree with you. I think if you were to go down the path of trying to build a competitive efficiency of either doing broking or maybe syndicating mutual funds in direct plans, we'll be kind of directly coinciding with people like Zerodha or Grow and so on and so forth. And I think really from a culture perspective as well as what we are building out, it's not really the same. I think there is a mid segment there between that versus what we are doing, which is largely the 5 to 25 crore segment, where I think from an aspiration and understanding perspective, they are slightly more skewed towards the wealth management side, as opposed to the current service which they are getting with most of the financial institutions they're dealing with. So I think there's a from a service delivery perspective from our side, it's more akin to the wealth management delivery we give to our ultra high net worth clients. It's just that we have to offer that service and distribution on a slightly easier, more effective, light touch digital platform as compared. So I don't think we're changing the core of what we do. It's just the delivery platform which needs to change. I think if you were to change the core of what we do and try and go down to a segment below that, I think I would agree with you. It would require a lot of cultural changes within the firm, and which obviously kind of in some senses reduces the probability of success.
Secondly, account aggregation is being highly spoken about in the entire industry. And so first of all, do you think that this would be a big leverage to you in that 5 to 25 crore category and the digital tools that you are going to implement? And secondly, how does that play out on the ultra HNI segment as well?
So I think for both the segments, it's quite important for us to be able to once the entire asset aggregator pool kind of comes together, because it started off with banks, then it's now moved to demat accounts and mutual funds. It'll take some time for all of it to come together. But for the ultra high net worth clients, we bought a small technology company called Altior around about 2.5, maybe 4 years back. And we've been using that software like Perfios in banking to be able to aggregate all our client portfolios across advisors very successfully for the last 4 or 5 years. So we spend a lot of time and energy on building analytics across our client portfolios on the ultra high net worth side for many years. And I think we'll be in a very good position to leverage all that we've learned over the last 4 or 5 years and transcend them to the output which we get from the account aggregator report, both for the 5 to 25 crore segment as well as the 25 crore segment plus.
Last question. With Bain coming in, do you think any broader level strategy or anything that would, from a say 5 to 10 year perspective, changes or incremental things that they are thinking about to implement differently what you would have seen, say, possibly in the last 5 years?
Not really. It's in some senses, I think it's a secondary purchase between General Atlantic, Fairfax, and Bain. So obviously, I think it's up to us to be able to get the best on global benchmarks and global advisors, which large shareholders have to offer. And outside of that, largely like before, it continues to be driven largely by the direction of the board and the management, along with the right counsel and advice by the right shareholders who are represented on the board.
Thanks.
Thank you. We'll move to the next question. Next in line, we have Abhijit Sakare. Kindly unmute yourself to ask your question, and please introduce your firm.
Hey, hi. This is Abhijit from Kotak. Just a couple of clarifications. Karan, if I heard it right, did you actually say that you're able to bring in new clients directly into IIFL 1? Not really.
Yes, absolutely.
Oh, is this a recent phenomena? What has really changed here in terms of client behavior or your proposition, pricing? Anything that you can elaborate?
No, so I think the newer clients all really honestly want to come into onto the advisory platform for the last 6 to 9 months, especially. See, what happened is 2.5, 3 years back, post change in regulations, maybe we were only a couple of us talking about advisory. Now, if you go out, all the top 8, 9, 10 wealth managers are, the first pitch, honestly, is graduating towards advice as opposed to distribution. So even from a client perspective, it's becoming more the normal lay of the land as opposed to an exception lay of the land. And therefore, I think as time goes by, and I think that time is now and it started, more and more clients will move towards advisory from day one, rather than head into it on month 6, month 9. What it's also resulting in is a little bit of stability in pricing, still very, very early days. But I think clients will end up with some bit of stability in pricing and seeing the benefits of that, at least from our limited client set. We are seeing early shoots of some stability happening there on the pricing side.
Just a couple of follow-ups. Are RM incentives different when they're able to bring in a client directly into IIFL 1? And the reason for asking is that probably I think elsewhere the cost income ratios tend to be at a higher end when you are looking at pure advisory model. Correct me if I'm wrong, but is this true?
No, so if you just look at pure recurring revenue, obviously the cost to income ratios will end up being slightly higher even for us, right? If you kind of strip out the transaction brokerage revenue, but it's an evolution. So I think we're for anybody else, the cost to income will keep improving as they move a large portion of their income from transaction and brokerage to recurring revenue. I think we are 60-70% on the way in that journey. Others might be 30-40% on the way to the journey. But typically speaking, in very good markets, if you've got a very high transaction brokerage revenue, your cost to income will look very attractive. But in tougher markets, it'll start looking very sharp. Whereas for us, it will be slightly more normalized. In tougher markets, it'll look better. And in really good markets, it's not as if it will improve phenomenally, because transaction brokerage revenue will continue to be relative to competition, a smaller portion of the number.
Got it. Last one is that on the new client wins which are happening, which is essentially driving the flows every quarter, are these the clients who are like new to this kind of a setup, or you kind of acquiring clients from competition? Any sense on that would be helpful. Thanks a lot.
I think it's a combination of both, Abhijit. I think clients from competition as well as new. It's just that the clients you acquire from competition take slightly longer to scale up. So the immediate impact on the AUM is slightly lower because nobody's able to transfer everything en masse. It takes some bit of time for them to move AUM. Obviously, a client who's coming in afresh with a new liquidity event is more or less investing everything afresh. So in that sense, it becomes a slightly more disproportionate part. And therefore, though, if you look at clients acquired from competition and absolutely new clients, the ratio will be maybe 70-30 in favor of clients acquired from competition. In terms of AUM, it becomes the reverse, because the client who's kind of getting a liquidity event is investing the entire money today. And therefore, it's kind of becoming 60-65% of the AUM is coming from there, and 35-40% is really coming from the existing clients.
Got it. Thanks a lot.
The next question we have from Ganesh R. Kindly unmute yourself and ask your question.
Ganesh, I think you're on mute. Let's move on. We can't hear them.
Still on mute.
Yeah.
Karan, I don't think so. This is Ganesh here. I don't think so. It's from my side. Sorry.
Oh, now we can hear you, Ganesh. Sorry.
Yeah. No, I'm saying that there's no question from my end. I don't know. This has got triggered.
Okay. Thank you.
Thank you.
Great. Thank you everyone for the call, and I wish all of you a happy Diwali and festival greetings. Thank you.
This brings us to the end of this investor call. Thank you, ladies and gentlemen, for joining us this evening. Have a nice evening.